we are live now. Thank you very much, and also from my side, welcome, Martin. Great pleasure to have you with us today. The book that we are talking about is The Economics of Belonging, and it is one of the big themes of our times, as you said, Klaus. But beyond the book itself, it's also a great pleasure having you here as a person, Martin, because I think, well, we all know you from your Financial Times, your regular publications in the Financial Times, when you comment on European issues and when you comment on global policies. But one often also has the feeling that there is an idea behind it when one follows your contribution. And in fact, I mean, next to your Financial Times publication, you have also published 3 books. And the first one on business ethics, the next one on the euro, and then the third one, The Economics of Belonging. And this gives the notion that you have there is some bigger idea of what you want to communicate about economics. And just maybe to open our conversation up, you can share a few words with our audience on what is the drive for you to write those books? What was the drive for you to write the book on the economics of belonging?
Well, thank you, Rolf and Klaus. It's really a pleasure to be with you. I wish we could meet in person, but you know that may still happen in the future. But it's it's very nice to be virtually at least meeting you all. You're an institution that was sort of born in difficult circumstances and have had difficult tasks in just what you've had to do and building yourselves up. And I've followed you from the start, and you still have important contributions to make. So it's very nice for that reason to be with you. Look, there are sort of a couple of answers I'd like to give. Maybe three short ideas. One is in terms of kind of personal biography or intellectual biography. I could never quite make up my mind what I wanted to study. Right? I started doing philosophy in high school. I went to high school in France. They're big on philosophy there. And then at that time realized if I want to understand politics and how the world works, I need to study economics. So I went to Oxford to do philosophy, politics, and economics, the PPE course. And I sort of never put that behind me. So I went to Harvard to do a PhD in this program. Some of you may know about political economy and government, which is kind of has one foot in the economics department, one foot in the political science department, one foot in the Kennedy School. So basically, I tried to keep doing economics and philosophy and politics at the same time. And I had a short academic career. I taught at the Wharton School in the business ethics department there, and that's what the first book came out of. And then at some point jumped ship from academia because an opportunity arose at the FT to be the economics leader writer, which turned out to be a very good opportunity to think both kind of philosophically, normatively, ethically about things and use my economics training. But I've tried to kind of continue to do this throughout, and I still think of myself as being an economist by training, but also having some feet outside of economics. And, maybe that's why I manage sometimes to be somewhat innovative, maybe come in with more surprising perspectives, because I'm sort of partly freed from the convention, both intellectually and professionally. I mean, I mentioned to you, Rolf, when we had a planning talk that my thesis committee chair, PhD committee chair, was Amartya Sen. So I kind of, had that slightly parallel look from the outside of economics into economics with me throughout. So that has always been part of how I approach these things intellectually. But the second answer is that I've realized, almost by revealed preference, kind of thinking about the books I've written and what I often write in the FT, that I very often see or analyze the economy while understanding the structural issues we all try to analyze as economists, really identify the opportunities for politicians to make a difference, that choices matter, right? And looking back at each of my books, there's a consistent theme of saying, look, things could have been done differently here, or you can do them differently now if you step out of the box, to use a cliche. But I think of that partly as being a democratic citizen, holding our leaders to account, saying, you know, it matters what you do, and here is why, in my view. But then coming to this book specifically, which that's the one we want to talk about. This was all pretty much certainly thought out and pretty much written before the pandemic hit. I have memories of looking at proofs on my last trip before the pandemic, which was sort of Brussels, Washington, New York in early March 2020, and sort of frantically trying to finish spelling mistakes or whatever. And there was no time to add in thinking about the pandemic. So this all came from, it was basically the experience of 2016. Like many of you, I was shocked by the politics of that year, the Brexit referendum, the Trump election, and you know, spent a couple of years trying to work out, in my way of thinking, what happened, why did it happen, what does that mean for how we should think about economic policy, and the result is this book. We'll want to talk about the pandemic, I'm sure. You know, I'll just say in one sentence that I think the things that I realized in working with this book became all the more relevant and intensified really in the pandemic. So personally, I think the message is even more relevant, but then I have a book to sell. But it really was for me seeing this political challenge against the social and economic and political model we all knew since the Second World War, end of the Second World War. I was a teenager in the 80s and in 1989. I have family both on the western and eastern side of the Iron Curtain. Sort of personally for me, I'm that 1989 generation thinking that liberal democracy has won. Fukuyama fan, if you like. So again, it was all of these personal things trying to say, how do I make sense of this? And the outcome is the economics of belonging.
And indeed, super interesting. And I think there are the 2 points, right, that really are so critical for the current situation is, as Klaus also referred to, making sense out of that. What is the big question? And then thinking out of the box how to address it. And that is what is so important these days. And I think also the other point is the notion of inclusion. I mean, we at ESM, we are basically there also for people's welfare, and inclusion is one of our core notions. So without further ado, then maybe I give you the floor. So let me just tell for the audience and also welcome everyone on this call who has dialed in, connected right now. So we are going to have this conversation first. Martin will have 15 minutes to talk about the book and present the different thoughts, because evidently we don't expect anybody to have necessarily read the book, and this will provide the background. Then Martin and I will have a conversation on some issues. What is the current reading of the book, given the reset of the pandemic? And in the meantime, we already opened the floor for questions. You can please use the Q&A box that you see on the screen, and then we turn later on to your questions. So with that, Martin, the floor is yours.
Thank you so much. Look, I've sort of set the scene for why I wrote the book. Let me say one word about the title, Economics of Belonging. And in a sense, I think it's an example of this this theme I told you about at the start. You know, trying to think about the economy and about economics, but in a way that kind of captures these broader concepts or a broader understanding of society and the human experience in it. And belonging, the term belonging really worked for me to do that, because the first half of the book it's called What Went Wrong. So it's trying to give my account of the questions we just raised. You know, what happened in 2016, the build up in this backlash before it, because I really think it is about belonging. I try to take the populist anti-liberal movements seriously in the sense that let's listen to what they say, and what they tell is a story about belonging, or an end of belonging, that there is a group in society for whom the economy hasn't worked, that have been left behind, if you want to use that terminology, who don't really anymore belong to the sort of system that the governing elites, the political classes, have been running for decades. That's the story you hear. You know, the selling point of these movements is, so throw them all out and go with us instead, because this is not how they put it, but they could put it this way, we will restore your belonging, your place, rightful place in our societies. And once you put it that way, you have to accept that they have a point, because there have been economic changes over the last 4 decades, I would say, that have worked out badly for a pretty identifiable group of all Western societies. So in the first part of the book, I set out in part what's happened. Many of you know most of this story very, very well. We've had an increase in inequality of incomes, of wealth, a bifurcation of polarization between those with higher formal education and those without it, their opportunities. All of this has increased since about 1980 in pretty much every high-income country, after a period where those differences were diminishing for about 3 decades after the Second World War. One final dimension of this that until recently wasn't sufficiently appreciated is the regional dimension. So it's not sufficiently well known that, again, in pretty much every Western country, every high-income country, regional inequality fell in the first 3 decades after the war. And that convergence, intra-national convergence, came to a halt around 1980 and even went into reverse in some countries. And I think a lot of this story of belonging has to do with place. And again, you can look from country to country. This political backlash was particularly strong in places that had declined in the last couple of decades. So one big argument I make in the first part is that the economy plays a big role in this. There is a debate about, is it culture or is it the economy, is it economics? Of course, a lot of these political conflicts have a cultural tinge, a cultural expression, a values expression, but I make the argument that if you look properly at what's happened in the economy, the economic changes are so evidently aligned with subsequent political reactions that we need to say that there's a foundational role of economic change here, and we'd be silly not to accept that. Even if it takes a cultural expression, there is reason to hope that if we can fix the economic divergence, we can also make the politics less toxic. So that's argument number one. The economy matters for these political phenomena. I'm getting a little message here that my internet connection is erratic. So, if I have an interruption, just let me know and I'll go back.
Works fine so far.
The other economic argument in the first part of the book has to do with globalization, because there are people like my friend and former teacher Daniel Roderick who are committed centrist liberals and will say a big part of the problem is that globalization has gone too far. So I disagree with that, and I want to make a big point about globalization is not what caused these economic divergences, these economic problems. At most, it had a marginal effect. But the timing is wrong. The cross-country differences are wrong in terms of that story. These big changes really happened, as I said, around 1980. Globalization, as we know it, really only started taking off at the end of the 80s and then later on. And of course, we know that the most open countries, the Nordics in particular, are often the ones that have navigated these changes the best, whereas the US probably has navigated it the worst, and it's a very closed country compared to most of Western Europe, for example. So that's the other argument I make in the first part. Look, it's about the economy, but it's not about globalization. So what is it? It's technical change. It's automation. It's computerization. It's all these things that increase productivity in manufacturing. So the one thing that happened everywhere around 1980 was that the absolute number of factory jobs peaked and then started falling. As a share of employment, it had been falling for a long time, but in absolute numbers, give or take 5 years, 1980 was the peak. And that has effects on who has the better prospects, which places has the better prospects as you shift from a industrial economy that can be fairly evenly spread across the territory to an economy driven by high value added knowledge services that thrive in the big cities. That in a nutshell is the story. And that means this is not going to stop, because we keep having technological change driving these structural transformations. Retail is being transformed by the internet. A lot of clerical mid-skill jobs are transformed by computerization and will be more by artificial intelligence. We can just start to think about what will happen if we really get autonomous driving. So this will continue, and we'll continue to see similar changes as the end of the factory economy led to in the 80s and onward. So we'd better get it right this time, as well as trying to fix the problems we have allowed to happen. So that's the second half of the book. What is to be done? Well, I'll be the first to admit that it's very hard, and I can only now kind of rattle through some basic themes and principles, and then we'll get into discussion about some of the ones you find more interesting. But the overall message here is that we should embrace these technological changes that lead to productivity growth and harness that productivity growth. But the big challenge is to make that productivity growth work for everyone, or for as many people and as much of the national territory as possible. So that's a bit trite, it's a bit cliched, prosperity for all. But really that we sometimes, or politicians sometimes, forget to make that the goal. Don't try to resist productivity growth, technological change that makes some sectors more productive. Try to manage it in a way that, in a word, makes change safe for everyone. That's been the problem. Change has been unsafe for too many people. So how do we do that? As I said, this will really just be rattling through some principles. But one thing I advocate in the book is we should try to get rid of the bad, low productivity jobs. So many countries have allowed a precarious segment, a precariat in the labor market to develop, because as well-paid factory jobs disappeared, people instead got low-paid, low productivity service jobs. We should not allow low productivity jobs to emerge in high-income countries. That's just not the way the future should look for high-income countries. The goal has to be to have only, to make businesses choose high productivity, high labor productivity business models rather than an intensive use of low productivity labor. And it's striking how you've seen this precariat grow, not just in the very unregulated labor markets like the Anglo-American ones, but also in the most regulated ones, in France, in Spain, and so on. You've seen the same fringe, precarious work situation for those who are not inside the highly protective system. So I advocate, and here you will see my Nordic background come through. I'm Norwegian. The Nordics have largely succeeded in pushing high productivity labor markets by actually making it difficult to choose low productivity business models. Effectively high wages at the bottom, in their cases through wage bargaining, and other policies that just make it uneconomical for businesses to choose those sorts of business models. I compare in the book how car washing is done in Norway and in the US. In one, you just use machines. In the other, you use cheap immigrant labor. In fact, that's been changing over time in the two. We can get into that if you want to hear more about the example. But those are pictures of two different kinds of economies. So one thing is to engineer labor markets that actually favor high productivity rather than low productivity jobs. You obviously need to invest in skills so that people are able to take higher productivity jobs. But the second principle here is that in addition to making bad jobs uneconomical for businesses, you need to make it possible for those businesses that do offer high productivity jobs to expand. And this will be very relevant for the work you do. So I advocate much more aggressive aggregate demand management in order precisely to put in place the conditions to have faster job transitions, easier job transitions from low productivity to high productivity jobs, and to encourage those companies that do choose high productivity, capital intensive business models to actually expand so that they will end up hiring more people. So you have, on the one hand, use things like high minimum wages, better enforcement of workplace standards, more empowering of workers' rights, in order to incentivize businesses to choose the high productivity models that actually allow them to pay well. And on the other hand, have aggressive aggregate demand policies that allow the businesses that do that to expand, give them the confidence to expand. No doubt we will want to talk quite a lot about that. A third principle is to, along this message of boosting and embracing productivity, you need to have a good competition policy in place. So you want to avoid those market concentration, the phenomena of market concentration you see in the digital economy, but also in traditional economies. In the US more than in Europe, it has to be said. But again, that hold back productivity growth, because you really want to have productivity growth wherever you can get it. And greater competition helps with that. That means competition in product markets and greater competition in labor markets, precisely to increase the rate of transition, to smooth this sort of adaptation of the economy. So you protect workers rather than jobs, if you like. I think it's instructive here. A lot of people don't know this. I'm sure you all do, but I keep repeating this because people are surprised when they hear it. The two countries in the EU with the highest rate of job-to-job moves, the highest churn in the labor market, are Denmark and Sweden. And it goes to show that you can have fast churn and, if you like, unstable jobs in a way that improves productivity. Two more ideas before I end my introduction. In order to have both this fluidity and to have effective demand management, I think you need to move from economies where financing is largely based on debt, and in particular bank debt, to economies that are more based on equity type financing, either literal equity financing or financing that behaves like equity. So to the extent that it's credit that is easily written down, easily restructured. So you can think of that through bankruptcy schemes, pre-packaged bankruptcies, debt contracts with written in workout schemes, and so on. This is obviously at the core of what you do. So I'd love to have a discussion about that. But I think that both helps governments manage the macroeconomy more effectively. Monetary policy, for example, will have more traction on the real economy. And it allows for restructuring in the real economy, shifting capital and labor from less productive to more productive work. So there is a chapter in there on the financial policies you need with that. And finally, last but very much not least, I mentioned regional inequality. You do need regional policy. You need a policy of place to make all of this work in a sort of aggregate territory, whole of the nation sort of way. And that is the hardest nut of all to crack. Generally, most countries don't manage to do it. And it's not just about redistributing to compensate for income differences between the leading parts of the country and the lagging parts of the country. What you really want to aim for is an equality of productivity across the country. So you want productivity numbers to start converging again. Very, very hard to do. We have examples of places where it's worked, areas, regions that have recovered, some countries that have managed to keep regional divergence at bay. But the main message I give in the book is that what you want to do is to make it possible for these modern cutting-edge knowledge services jobs to locate in more places than they currently do naturally, which are basically the capital cities. For that, you need a whole lot of policies to go right. You do need resource transfers. You do need infrastructure. But you also probably need to seed these sorts of high knowledge, highly educated service jobs in some areas to try to create new clusters. I will just stop there because there's so much to say about it, and I want to see where your questions, Rolf's, and the audiences go. But that's a sort of, in a sense, a list, a recipe of things that can make economies work better. Last thought is, it's not just a list. Both economically and politically, I argue that it works better when you try to do all of these things at the same time. So this is why these days I argue very much for a big push, a kind of comprehensive transformational policy. And that's why the subtitle of the book has a radical plan. You know, the publishers wanted to put that in, but I agree with it. This has more prospect of succeeding if you do it comprehensively than if you do it incrementally.
Thanks very much for the broad outline, and indeed a number of points to take up on. I mean, first, let me also say that I can relate to a lot in the book, and certainly the fact that it's in a staunch defense of liberal democracy, a staunch defense of globalization, and a staunch defense of equality, and also at the regional level. All that bodes very well with me. Maybe to follow up, let's first maybe take a point on the politics and then go into the economics. I mean, you said something about the thoughts, how that originated with Brexit, with Trump, and where you saw kind of populism popping up. Now, if you move to today, right? So we have the Biden administration. We have also kind of opinion polls on more populist parties in Europe, kind of leveling off or kind of at least plateauing. For me, the impression is also that some of those movements got kind of a reality check with the pandemic. And but what is your view on that? I mean, are we, so to speak, beyond it, or is it still there as a sleeping risk? Or now that those sentiments have found an organizational form, how do you look at the current politics?
Yeah, no, really good question. And I think we need to ask the question in sort of two phases, you know, a year ago when the pandemic hit and now. Because when the pandemic hit, I mean, all the things I've said have kind of been intensified in the pandemic. It's the, you know, inequality has increased, as we know. It's the people in those precarious, low productivity service jobs that have borne the brunt of the pandemic, either more exposed to the health risk, more exposed to the economic risk, because those are the jobs that were more likely to be hit by the lockdowns. But we also saw, I think, a kind of prise de conscience socially, where everyone, including us who have been relatively comfortable, we can do our jobs remotely across the screen and so on. We sort of realized how bad things were in some segments of the economy. That, I think, created an opportunity to say, well, yeah, actually, we should address this. And also among the politicians, they were forced in very little time to become radicals, sort of accidental radicals. Everyone's done things they would previously have thought inconceivable, right? So we're in this new world where the previously inconceivable has happened, so of course we can do more of it. Question is what we choose to do. Now, I was thinking early in the pandemic that if we don't now finally start to address this, if we don't build back better, as the slogan now goes, you know, look at how populists benefited from the previous time we let inequalities increase. If we don't fix it now, just wait for what the next backlash will be, right? But then I think on the whole, centrist politicians stepped up and showed that they did take this seriously. And I think people, as you suggested, Rolf, saw that the populist protest movements, you know, they're maybe not very good at competence, right? At really sort of dealing with this when in a real crisis. They didn't really have good solutions. So I think this has been a big setback for them. But again, it depends on what happens next. And now actually pretty much everyone is at least talking the talk, right? I start the book with thinking back to Roosevelt, Franklin Roosevelt, and how he sort of did what I advocate we need to do now. Big reform precisely to stave off the attraction of anti-liberal movements, fascism and communism back then, and it worked. Everyone now wants to be Roosevelt, right? The last, you know, Boris Johnson talks about Roosevelt. Joe Biden, we know, very self-consciously thinks about Roosevelt, and is actually going ahead very big. So I've sort of become more reassured that actually now there are some, and we could mention the Recovery Fund, of course, in the EU, very much bigger than anyone thought politically possible before. So I'm a little bit more reassured now. I think for now, the opportunity is being grasped. I think it's over the next year that we will see if people fall back into old habits or whether things have really changed and we're trying to do things in a new way. So it's a bit too soon to say, but I think if we don't actually make good on this promise to build back better, then the backlash will just be worse the next time around. So I think, we have a sort of respite. We've been given a second chance, if you like, in the worst possible circumstances, but we can really make something happen now. But my goodness, we really have to make it happen.
Oh yeah, there is a lot about the rethink, and also, as you said, the need to do better now, because if you don't manage, actually a lot of things may not be even the same as before the crisis, but they may be even worse, and then the backlash may be even stronger. But that brings us a bit to the question how to do it. And here comes the first tricky part from our perspective as well. And I mean, you in the book, you make the point about the high pressure economy, and now you said this aggressive demand management. And I think there's a broad-based consensus about why during the crisis you needed big support, and this is what governments did, and that was successful. What we did at the European level, also with the EU fund, and that also should and needs to continue as long as the pandemic and the health measures hold us back. But then there comes a more, if you wish, fundamental question with it. How do you look at that, and how far can you go with it, right? So and then there's the argument, well, that really doesn't matter too much now. And I think also there's little doubt that with so low interest rates that are not likely to return to levels that we have seen 30 years ago, countries have a higher debt carrying capacity. But still, I mean, we on our side say, well, after all, you should at some stage, you need to get back to also a fiscal path that gives you some buffers for the future. So how, and here's a bit this philosophical question. You said aggressive demand management. How far can one go, and how do you think about the buffers in the future that one needs to build up?
Yes, very good question. And of course, you you are also a creditor, so or a sort of intermediate creditor. So it's important. Look. One thing I try to do in the book is to at least put a question mark over the unspoken premise behind this whole sort of argument, which is whether a more aggressive macroeconomic aggregate demand management policy is actually riskier in terms of fiscal sustainability. So I've been arguing for some time that actually it may be less risky. That it's precisely by being more aggressive in terms of managing the cycle. I accept that means you have to manage the good side of the cycle well as well. But we can talk about that. Why is that? Why might that actually be better for debt sustainability? Well, partly because if you think that the supply side is to some extent connected to the demand side, that is really, the kind of crucial technical assumption in a sense here. It's an empirical question. But if you believe in hysteresis, or if you believe in reverse hysteresis, and that there are plenty of good reasons to think that the private sector responds to high demand pressure, at least in part through productivity improvements, then a lot of the standard framework we use with output gaps, with potential output, and so on, is not very helpful, or even the concept of fiscal space. So I want you to at least consider very seriously the possibility that it's by using deficit spending, or for that matter, very aggressive monetary policy, more, that you get higher productivity, higher level productivity in the long run, right? A bigger economy from which to service debts, whether public or private. If you think that's true, then really it's about leaving a free lunch at the table, to mix metaphors, right? Then we really want to get the highest productivity we can. And in most cases, that will also be good for fiscal sustainability. And in fact, it will be more important for fiscal sustainability the higher are the initial debt burdens you go into the crisis with. That's just a sort of pure arithmetic, that your ratio changes more with a given increase in GDP, the higher the original ratio is. So I really want to at least make sure that possibility, we don't take for granted the assumption that fiscal sustainability, the direction, is the way we have been trained to think. But then beyond that, there are better ways, or there are ways we haven't exploited to manage debt risks. And this is more obvious in the private sector, where there are fewer kind of systemic worries about restructuring debt. But this is why I think it would be better to have much more equity in the first place. And one example where this matters in the pandemic is, can we try to convert some of all this support that's been given in the form of credit to businesses? Can we convert that into something that behaves like equity? Why? Because if things go wrong, it's just much easier to restructure or to change the value of equity than to renegotiate debt. That goes in the private sector and in the public sector, as we all know from the Eurozone debt crisis. But also, even before we get to that point, if you don't have the overhang of debt, this worry that, well, this is something that needs to be paid back at some point, you're unwilling to take risk, right? And we do want risk taking. We haven't even talked about the climate transition, but that points in the same direction. So I know you're talking about public sustainability directly, but I think we have to put it in this broader context of how we deal with debt more generally. So on the public sector debt issue, I would say 2 or 3 things. One is lock in rates as much as you can now. Most governments can borrow for 30, 50 years at very low rates. So do it. What has really driven debt crises in the past are these rollover crises, right? And as we all know, the actual debt service burden now is lower than it has ever been for most countries, even though the debt burden, the debt ratio is higher than it has ever been. Lock that in now. And in fact, there may be much less to worry about if at least deficits then come back to normal. A higher debt burden whose cost is locked in for the long term, that is not something we need to worry about. What we need to worry about is, a sudden explosive cost of debt. But that can be avoided if we're smart now. And then, of course, in extremis, I want to apply the same argument I make for private sector debt to public sector debt. I think in the long term, we want to get to a point where even public sector financing behaves like equity. So that means debt restructuring mechanisms, ideally built into the bonds to begin with, bail-inable bonds for sovereigns, even moving to a system where we have some sort of sovereign equity, basically GDP-linked debt. But we need to make these moves, and if we make them now, then we can avoid that specter of disorderly default or disorderly restructuring further down the line. So don't let the fear of that down the line stop you from making the best choices today, is my message, basically.
Thanks a lot. One comment on my side and one further question, and then we turn to, I already get kind of a lot of messages on people having tons of questions for you. Maybe on the comment of what you said about demand management. Again, I think nobody contests that we need to support demand now. I really think rather the question is like, how far do you go? And you just briefly alluded to it. You also can relate to this issue of building up buffers for the future being a good idea. So in that sense, I would kind of count you on more in the camp of the surplus Keynesians, that when the good times are there, you actually should save in order to have the space to the fiscal space or do kind of aggressive demand management also in other times. So it needs to work over the cycle, which I think is the first important point. The second question is, and here you see the difference, I guess, somewhat between the US and the European approach, is also the question of efficiency. What is the bang for the buck that you get? And you said indirect aggregate demand management for you is the way to make long-term growth work. And I think to some extent that is right because it supports investment. But at the same time, there is a question of a policy mix, right? Is this the most efficient way to do it? Are there other ways to do it? How much can you do with reforms? And there is, I think, where the Europeans take a slightly different approach. And I think the future may tell what is more effective in that. But I think this is a twist on your view, I think, which is probably consistent with what you said. And maybe I want to highlight a bit more from our perspective. But let me follow up on this one aspect before then turning to the floor. You mentioned a couple of times about equity finance. And again, I mean, we have also said and advocated and capital market union in order to get more equity finance. We have, I mean, we are in favor of that because we know that too much debt in the private sector also holds the private sector back. But at the same time, and you say it needs to be applied even more broadly to debt, even public debt. There are 2 points. This can be maybe a long-term process. It maybe doesn't help now. So how can we get there now to the equity finance that we need? The second point is, and it's not cost-free, right? The return on equity is higher than the return on sovereign debt for a good reason, because people believe sovereign debt is safe. And that is why you get it at a much better price. So, I mean, if you say everything needs to be equity financed, well, that's in a way also an expensive transition in a way, right? So how should that even conceptually work?
Very good. Just one sentence on the surplus Keynesianism. Yes, you know, save in good times, but not because you have high debt. You know, reduce your deficit, right? So balance the deficit more or less over the cycle, you know, accounting for growth potential and so on. But it's not because you have high debt that you need to save more and reduce the debt. Those are two different things. You know, we can refer to Blanchard's American Economic Association address here. Now, on debt and equity, let's not forget that we tend to, most systems subsidize debt, right? So yes, debt is cheaper because people think it's safer, but we also generally in the tax system subsidize it over equity. We could at least start by stopping that, because there are, you know, call it good externalities. Economies are stabler if there's more equity in the financing mix generally. So we should think of promoting equity. You know, capital markets union is sort of the direction you would take that in the Eurozone and EU context. So there is a role for debt, no doubt, but the balance should be very, very different. On the public sector, specifically, how do we get there? Well, I think we can start by trying to at least experiment with new instruments now. You know, there is a lot of debt being issued. Why not issue some of that? Let's also not make it a binary thing. There's kind of a spectrum from ever longer maturity debt to equity, right? Ultimately, you know, zero coupon perpetual is equity. It's probably worse than equity, actually. But equity, what we should think of as equity financing in the sovereign context, is basically a share in the economy's growth, right? And I think there's an attractive investment proposal to make to many investors who currently hold sovereign debt to have investments that share in a country's GDP growth. That's the way you would want to think about it. So you would want, I think, to start now offering a significant share of sovereign funding in the form of something that varies quite strongly over time with GDP growth fluctuations, or from year to year, I should say, with fluctuations, but over time links up with how the economy does, so that there is an important upside. And given how cheap sovereign debt is in terms of funding costs, how little it yields at the moment, you know, we keep talking about G versus R from a public funding perspective, but think of it from the investment perspective, the investor's perspective. If G is higher than R, well, you might want to get some of that G, right? Ultimately, of course, G or GDP is all there is for investors to get money from. So debt is simply a prioritization of different kinds of investors. In the end, G is the real income to distribute from. And I think we just want to bring that into the investor community. You know, start with pension funds, start with institutional investors that are in some ways linked with the state.
I guess we discussed it also many times here. There would be some questions on from the funding side. The other point is obviously next to G, and that meaning growth here, now we have E coming into the market. So there will be a lot of experimenting in the market, and we will see how it evolves in the long run. Let me open for the floor. I think, and maybe first I just quickly turn over to Marcus, who raised his hands. Who has a question on the international economy. Marcus, do you want to come in?
Hi, good afternoon. Thank you so much for your seminar and also for your book. I haven't read it all, but I've read a lot of reviews and the summaries. So I obviously do agree with most of what you said, and there's great, very detailed policy recommendations with which I think I totally agree, and it's very, very helpful. I wanted to step back a bit and ask you if you, and I think you yourself describe it in a way, the two big trends globally, economically and socially, it's the redistribution of income globally. It's the Milosevic elephant shape of redistribution that in the end, for many of our manufacturing jobs and so on, the real wage in advanced economies simply turns out to be too high. And there is adjustment here, which creates a lot of friction. And it needs to happen and has benefited many countries. And the other thing is technological change, the very rapid technological change that makes more and more even mid-level service jobs and the low-level basically redundant and also makes them tradable. So these two big trends are there. And at times, your recommendations smell a little bit of stopping these trends or arresting them or containing the speed of them. And I wonder where you place yourself in that spectrum. You know, for example, just simply not allowing low-level productivity jobs in advanced economies, meaning you don't allow anybody to mow your lawn for free, or not for free, but for a low-level thing, or you don't allow anybody to wash your car as a job. That smells a little bit of restricting immigration and restricting sort of the flow of the economic adjustment. You know, how do you see that? And at the same time, you know, if you think of a world in the future where most of these mid-level service jobs also will be automated and tradable, that's great for hundreds of millions of Indians and Asians and many and Africans. But again, a huge need for adjustment of real wage in advanced economies. Not just manufacturing jobs will disappear more or less, but also very many service jobs. So are you on the spectrum of halting that or stopping that or slowing it? I can see the point of slowing because, you know, the very rapidity and at the same time creates these political upheavals. That's my first. And then in the end, if you think of it from an economic liberal model that we all subscribe to, that in the end, private enterprise has to find its most productive way of operating, are we in the end better off looking more for redistributing the resulting incomes very draconically if needed, as you said, through basic incomes and so on? Or are we also in the business of slowing this economic adjustment, or both?
Excellent question. Rolf, I'm conscious of time. Do you want to take a few more questions, or do you want me to answer that first?
I think that was by itself already quite a bunch of questions.
Yeah, I mean it's a fundamental question, so I'll try to do it. I'll try to do it justice. One of the last chapters in the book does try to take this on directly. So when you get to that, you'll get a fuller answer. But for now, look. No, I don't want to put a brake on this, and no, I don't want to slow things down. And let me explain why. You talked about manufacturing. So here's a fact. Again, one of these facts that aren't sufficiently appreciated. Manufacturing jobs have fallen everywhere in high-income countries. Manufacturing output has not. Right? The US produces more cars than it has ever done. And you go through every G7 country and every other country I've looked at, this is true. That we are basically close to record highs, historic record highs in terms of manufacturing output. So it's just not true that manufacturing left. Some subsectors left, some jobs left, but on the whole, it didn't leave. It was just that it left workers behind. It was the lowest productivity jobs that were moved, to the extent that they were moved. That's textiles largely, or typically textiles. But manufacturing hasn't gone away, right? It's just that you don't need many hands. Because you have much more productive production facilities. That's a good thing, right? It means there'll be fewer jobs there will never be many jobs in manufacturing again in high-income countries, but those that are pretty well paid because they're super productive. And that's what we want. And we want the same in services, bring on trade in services and try to get as many people in high-income countries to be qualified enough to work in high-value added services. Now, some services will always be local. Mowing your lawn is a perfect example. I do not want to stop immigrants from mowing your lawn. I do want to stop them from doing it on the cheap. So Here's an example I look at a bit in the book. I compare the UK and Norway in terms of immigration. So in the UK, immigration was a huge issue politically, right, in 2015, 2016. Mostly because of the accession country workers coming to the UK after 2004. Well, Norway too opened up the borders, the labour market completely, like the UK did from 2004, and actually had a higher inflow of workers from accession countries in the decade and a half that followed. But you never had the same backlash against immigration. One thing Norway did that the UK could have done and didn't was to avoid downward pressure on wages in those typical professions that immigrants took. In Norway's case, it was administrative extension of bargained wage agreements. Cleaning was one subsector. Some other subsectors where you typically get a lot of immigrant labor. The UK could have raised its minimum wage, enforced it better, just so that these jobs could be done by immigrants, but not on the cheap, right? That's basically what I'm calling for. The effect could be that fewer people move to work because fewer of those jobs are offered. But it wouldn't because we try to stop either immigration or outsourcing of jobs. It's because we allow that so long as the jobs are good ones. If the outcome is somewhat lower flows across borders of people or of capital or of goods, so be it. But this is compatible with globalization. Keep the borders open, but domestically put in place policies that avoid the sort of damaging undercutting, and then you can leave the borders open. But that requires some proper enforcement. But the main point of the book here is you can actually have liberal globalization while having better policies at home. This is kind of a big point possibly of disagreement. Some will say, Danny Roderick will say, no, actually, that's not going to work. I think it can work, that there's enough you can do at the domestic level. You have enough levers to avoid the sort of undercutting you worry about without closing borders.
I think it actually, thanks a lot, Martin. I think this actually addressed a couple of questions that came in. There is one point on the Scandinavian model, and maybe I can briefly turn to Niels. Niels, do you want to intervene? You are muted.
Sorry.
Niels,
yeah, can you hear me?
Yes. Yeah. Okay.
Okay. So yes. So thank you very much. I mean, and very, very interesting to listen to. So my point would be also a bit along the lines of Marcus now, but let me take the Scandinavian perspective, because you refer to that the approach has been different. I mean, I think in Scandinavia, the reason why this has been possible also is that this labor market policy and with minimum wages that can push up productivity and so on is somehow linked with the welfare state in general. The fact that we are ensuring each other, there is kind of an implicit social contract, so to speak, in those countries. Against this, I would ask you, how realistic do you think that it is to apply some of the same things in other countries that are very different? Let's say in the US, where you don't have the same kind of homogeneous population, where this kind of implicit social contract is possible. Do you think it's realistic to go along these lines here, or what do you think?
Yeah, that's another really, really good question. I try to be clear in the book that don't think that you can somehow move the Scandinavian model of collective bargaining to another country. It's politically rooted, it's culturally rooted, it dates back to the 1930s. It's sort of a social habit of how things work, and you have no hope in just kind of transplanting that. So we need to be very clear about that. Too many people kind of get very, admire the Nordics very much and don't take that seriously. But what I ask us to do is to look at the economic functioning of those culturally and historically specific institutions and see if you can mimic the same economic functions through other policies or other institutions that might work better in your country. So two examples from the Nordic labor market institutions. Because of strong and widely shared with wide coverage unions, you have a tradition of collective bargaining. But the economic function is that because wages at the bottom are very high, companies substitute away from low productivity labor and into capital. And so, you get high productivity jobs instead. So I'm saying, well, take that economic functioning. How else can you try to achieve that? Well, with an ambitious minimum wage policy, for example. We'll find out in a couple of years. This is being played out excitingly in the US, for example, with the fight for 15, and maybe Biden will increase the federal minimum wage to $15. We'll see. Another example, in the Nordics too, you get high levels of technological adoption at the firm level because you have sort of good collaborative attitudes between workers and managers because of this union tradition where unions are seen as constructive. Well, in other countries, unions are not seen as constructive and often are not, to put it mildly. But again, are there policies we can implement to try to sort of replicate or mimic that effect? And I mentioned some in the book. If you don't have well-functioning broad unions, well, what can you do? Well, you can try to have government policies that fulfill some of those functions. For example, think about how you represent workers on boards, how you represent workers in management decisions. That's one thing. Think about in the platform economy, how do you secure the sort of rights that unions have attached to specific jobs in highly unionized countries or in the highly unionized past in places like the US, and see if you can mimic that through a modernized welfare state that creates portable benefits. So this is the way I want to think, right? Look at the economic functioning of successful institutions and see if there are ways to mimic that functioning elsewhere.
Thank you.
I think a very valid point. And again, here also with the technological change that we see and with the possible movement towards more services, kind of finding those different ways will be more important in the future, right? So you cannot imitate, but you need to find a solution that fits to the politics. I think, again, you replied to a number of questions that were raised about how realistic these ideas are. And whether one should be afraid or whether there will be a movement towards smaller governments. At least I think my interpretation of your answer is don't be afraid of bigger governments as long as they do good in a way. Maybe before closing, since we are running up against time, just one final point from my side and then we close, because it's an interesting phenomenon that comes with the pandemic is we have talked about regions. Now, how much do pandemic developments give you also hope that with technology we will see more decentralization? So this kind of regional convergence will be a somewhat easier business, hopefully forward-looking. Would you agree with that?
Yeah, great question to end on. And it's, I want to say I'm also happy to see that the ESM has done some work on regional differences because it's crucial. The short answer is yes. I think there's at least a possibility that we didn't have, or a greater possibility than a year ago, because we've had this step change in technological competence. And we've seen that a lot of these very good jobs can be done from many other places. But I think it will take very smart and active policy. It's not necessarily about a bigger state, but a more intervening state, to use an ugly word, a more active state, to use a nicer word, that may be needed. And I think this is an excellent example. I think governments will have to make a choice whether they want to create incentives to keep some of this possibility for high value added, high paying jobs to be done in places that themselves haven't been able to sustain a kind of ecosystem for those jobs. I've noticed that Ireland seems to be wanting to do precisely that. We'll see if they succeed, but they at least have made it a policy goal and are planning, I think, some tax incentives to allow for people to have those sorts of jobs. Elsewhere, you will need the infrastructure. You will probably need to think about this idea of deep work, where people kind of meet once a month for a few days to create those personal connections. So yeah, it makes me very optimistic that there's at least the possibility, but we have to want to make use of it. It's not going to happen by itself. But again, this comes back to where we started, really. The theme in everything I write, I think, is that, look, there are policy choices and political choices to be made here. You know, the future is quite open, even within the big structural dynamics we're describing. So I would encourage every policy advisor in every government to really try to formulate policies to make this happen.
And I wholeheartedly can join into that, because, as you said, we have done some work ourselves on that area, and we clearly see the importance of also getting the regional dimension right. Martin, thanks a lot.
No, thank you. Thank you very much for having me.
For great explanation. I think great vision in a way also. I think a lot of those ideas and the questions that are related to it will accompany us actually for the years to come. And we hope that many policymakers can think even out of the box in finding the right answers. Thanks a lot, Martin.
Thank you so much for having me. And if I can just say, you know, I love having these conversations and to be tested on these ideas, because nobody has a monopoly on the truth. And if anyone wants to be in touch, I'm easy to find. And if there were questions that couldn't be asked, you know, get in touch, and I'd love to have the conversation.
Okay, thank you. Goodbye then.
Thank you very much.